What if the biggest return your advisor generates has nothing to do with picking the right investments? This week, we're looking at the value of having someone keep you grounded when the market gets loud. The Vanguard study measured the difference between what a self directed investor earned compared to a benchmark index. And what they found was consistent. The self directed investor underperformed because of moving in and out of funds during up and down markets, not from the performance of bad funds, just bad timing driven by emotion. So today we're looking at the largest value add, behavioral coaching, which can add up to 1.5% in value per year. So let's jump right in. The two emotions that drive most investment decisions are FOMO, fear of missing out, and regret. And neither one is a strategy. FOMO usually rears its ugly head when the markets are up. CNBC is loud, everybody's talking about it, and you move money into the market near the top. And then you've got regret. It usually happens when markets are down, or sleepless nights. And you feel like you need to get out of the market, so you move to cash at the bottom. This cycle of moving in and out is exactly what Vanguard measured, and it's exactly what created the performance gap. The funds didn't underperform, the decisions did. Remember, in and out, you got to be right twice, coming out and going back in. So being in the market means accepting that it can go down. That's not a flaw in the plan, it's a part of it. So don't confuse short-term discomfort with long-term danger. Think back to the last time you moved money based on how the market felt. Was it the right call in hindsight? The antidote to emotional investing decisions is to create a personal standard. What does your money actually need to do for you and for your family? This is the foundation for what's called an investment policy statement, which is a written plan that defines your goals, your risk tolerance, and the rules you set for your money. It's the standard you hold yourself and your advisor accountable to. It's a simple philosophy. If you want growth, be in the market. If you want safety, be out of the market. It's very simple to say. It's very hard to figure out how much belongs in each category, and even harder to maintain as the market moves. Having that written standard removes the guesswork in the hard and emotional moments. The decision was already made when you were thinking clearly, not in the middle of a volatile week. Do you know where your money needs to be and the return that's needed for your financial success? Most likely, you or your advisor know exactly what you need to do with your assets. The problem is rarely logic, it's the emotion. I can be blue in the face telling you what you should do with your money. I can back it up with numbers, research, and history. If you don't believe it, or you don't trust your current advisor, there will likely be unintended consequences to the decisions that you make. This is why the relationship has to be built before the bull and bear markets that challenge your confidence. Trust built in the quiet seasons is what holds during the hard ones. You can't build it while it's raining. Emotional detachment is one of the most overlooked benefits an advisor provides. Not detachment from your goals, but detachment from the noise that pulls you away from them. So if you don't have someone you genuinely trust before the next hard market, that's worth thinking about today. Now, if you'd like to have someone in your corner and give you direction on what your money needs to do for you, I'd be glad and honored to help you with that. Click the link below to schedule a 30-minute call to understand what that process looks like. And next week, we're continuing on our series covering asset location and whether your investments are sitting in the right accounts. We'll see you then.